Good afternoon. This is Anna Pinedo, a partner at Mayer Brown. Thanks very much to all of you who are joining today's webcast, Preparing Periodic Disclosures for Life Sciences Companies. Before I introduce the other presenters, just a couple of housekeeping items. So you can download the presentation as well as some supplemental materials, alerts, and other materials that are related to the topics that we're going to discuss today under the resources list. At any point during today's session, feel free to just type in a question in the Q&A box on your screen. We'll try and get to as many as we can during the live session. And for any that we don't get to, we'll try and respond directly by email afterward. For those of you who would like CLE credit for the live session today, if you could please download both the CLE form and the CLE evaluation PDFs, also found at the resources link. During today's presentation, about halfway through, I'll be reading a CLE code. I'll repeat that CLE code in case you missed it at the very end of the presentation. You need to include that CLE code on the CLE forms that you send back to us. So with that, I'm going to, as you see on slide 2, we have a big agenda to get through in terms of the items that we're going to try and cover as companies work toward filing their 10Ks, their Form 20Fs, and think generally about their ongoing 34 Act filings. And with us as presenters, we're delighted to have with us, joining us from E&Y Polia Nair, and I'm going to ask Polia to just introduce herself and say a few brief words of background before introducing Dave.
Hello, everyone. I'm happy to be here today and help Anna and David with a presentation on current SEC reporting topics for the life sciences industry. I work for the National Office of Ernst & Young. We have a small group of about 5 people that specializes in SEC reporting. We help registrants with interpreting and applying the SEC reporting rules to their fact patterns, and we consult and advise on all forms of filings, regardless whether they're for domestic or foreign private issuers.
And with us as well, with us as well from Mayer Brown, Dave Bakst. Dave?
Yeah, hi, and delighted to be here. So I'm a partner in Mayer Brown's Capital Markets Group. I work with Anna and represent a number of life sciences companies that regularly deal with all of the issues that we're going to talk about today.
Great. Well, with that, to get us going, I'm going to hand things over to Polia to talk a little bit about, just provide a broad overview of the trends that we're seeing for SEC reporting companies in the life sciences sector.
Thank you, Anna. So if everyone turns to slide 5, we have a table that shows the 5 most frequent comment area topics for companies in the life sciences segment. This data is through the end of June 2018. Our most current data shows that comments on the topic of revenue recognition, accounting policies, and disclosures is moving to number 1 through the end of February of 2019. And we've prepared for you here a few example comment letters, particularly in the areas that are difficult to justify and explain away, but likely would require registrants to change their disclosures going forward. First of all, I know that a lot of our attendees today are attorneys working for companies, And I would say with respect to revenue recognition and the new standard that was adopted by almost all public companies during 2018, don't shy away from looking at the revenue accounting disclosures in the financial statements and assuming that those are solely the responsibility of accountants. Quite often the SEC staff is telling us they struggle to understand those revenue disclosures and what significant assumptions relate to which particular revenue stream. So accountants could get some help in expressing the disclosures a bit more succinctly and clearly, and keep top of mind that they would have to separate their narrative and description of each revenue stream separately to be able to help the staff and investors understand better the significant judgments exercised with respect to each one of those. And so if that clarity of expression and writing happens, we likely will be seeing less comments in this area. So far, the staff is asking a lot of questions on how companies have adopted the new revenue standard, but we see very few instances of where they're requesting registrants to make changes to the accounting policies and recognition that they have implemented under the new revenue standard ASC 606. So that's good news. With respect to R&D comments, there isn't much new here. They're asking the routine questions related to registrants disaggregating more clearly in their note disclosures, R&D by functional expense and project. Fair value measurements relate mostly to business combinations, and on the next slide we are showing you a couple of comments related to the management discussion and analysis. So the staff frequently comments when registrants simply repeat their accounting policies from the financial statements into the critical accounting policies section of MD&A. That tends to be easy, and sometimes there is a misperception for a lot of professionals and gatekeepers advising their clients to go that way and not inconsistency between the disclosures. That's counter what the intention of MD&A is. The critical accounting policies section within MD&A has to be much more robust than the accounting policies section in the financial statements, and it has to focus on those areas of accounting that require very significant judgments and assumptions, and those usually tend to be valuation of goodwill and intangibles, business combinations, financial instruments if that's a material part of the financial statements. Sensitivity analysis is expected if there is material fluctuations around certain estimates or assumptions in the valuations. And it could also be revenue and lease accounting if those are very material to the registrant and highly subjective. Now, we have observed pretty convincing trend over the last 10 years. SEC staff comments are declining in absolute terms, but we're also seeing them become more thoughtful and more likely to elicit registrants making changes to their disclosures. And we think this is largely a function of, first, the number of registrants is coming down over the years through M&A activity, so hence your comments, but also the reviewers assigned in the various industry groups within CorpFin that review the filings are getting to know their registrant over time and not asking as many questions. And when they ask questions, it's more likely that those are questions probing in an area that may require revision. So here is an example comment on duplicating disclosures from the policies in the financial statements to the critical accounting policies in MD&A. Again, that's a key takeaway for today. Another popular comment on MD&A and why MD&A tends to be the area with the highest number of comment letters usually is the robustness with which registrants explain fluctuations in financial statement line items, particularly around quantifying the various factors that are leading to a change year over year. And so, as an example here, if part of a change in revenue is driven due to an increase in volume of sales, that should be a separate figure quantified. Another part could be due to price increase in the product or a change in the product mix sold. or simply foreign currency fluctuations. Those also preferably should be isolated if the factors are leading to material changes. Some of the other more popular areas of comment are revenue recognition. I mentioned clarity in discussing all material revenue streams separately and identifying the significant assumptions for each stream separately. That's as simple as attorneys helping the accountants finish off the discussion of a particular revenue stream in a paragraph or two before moving on to something else. If they start mixing concepts between how they're recognizing the different elements of revenue, it can be very confusing to both investors and the staff reviewing the filing, and could elicit a comment letter that simply is intended to resolve the confusion that's caused by poor writing as opposed to anything inappropriate with the company's revenue recognition. Internal controls, particularly if the company has restatements, segment reporting, probing into the company's analysis underlying the identification of reportable segments. That seems to be a perpetual comment, a standing one, particularly for companies that on earnings releases are providing data and discussing figures and drivers of operational performance at a deeper level than the reportable segments included in the note disclosures to the financial statements. The staff ordinarily in those cases ask the registrants to provide contemporaneous analysis and documentation on how they aggregated those lower level components or operating segments into a reportable segment. And for those of you that are not that closely familiar with the accounting standard, ASC 280, which is the standard on segment reporting, requires that operating segments with similar economic characteristics be aggregated into a reportable segment. So there are some very specific quantitative and qualitative considerations to go through to be able to determine what's the right level of aggregation in reportable segments. So a couple of examples on internal controls over financial reporting. The first one on this slide is a comment received by a company that had a restatement. So they effectively went in and amended their 10K or 10Q because they had what we call in accounting a big R or a big restatement. The error was so significant and so material that simply adjusting it in the current period was insufficient without leaving the prior financial statements uncorrected. And the correction to the prior period is so material, quantitatively and qualitatively, that it required reopening and amending the filing. So this particular company had a big R restatement, amended filings, but failed to identify a material weakness in internal control. So the staff right away disagreed with the company's conclusion that the company does not have a material weakness in internal control. The second case is what we call a little r correction. And that's usually done in the current year 10K, in the current year financial statements, with a note disclosure. We disclose what prior periods we are adjusting, but we're not going back and restating prior 10Ks and 10Qs. So the error usually is quantitatively smaller, and also on a qualitative basis is not as material as in a big R restatement. In those cases, the staff rarely goes ahead and objects to registrants directly on their ICFR assessment of no material weakness, but instead they issue a typical comment letter like this, which is asking for the major considerations that the registrant exercised, and very important, they ask for a quantification of the maximum potential amount of exposure for misstatement. And it's usually that amount that quantitatively influences the staff's judgment as to whether there could potentially have been a material misstatement and a material weakness in internal control. Now, Anna, tell us a little bit about the link between disclosure controls and procedures and internal controls over financial reporting.
Sure, and thanks, Polia. This is actually an area where a lot of lawyers and a lot of practitioners also get confused. There is, at the time that these were implemented, the SEC staff itself and many commentators had noted that there is actually overlap in the part of disclosure controls and procedures that are designed to provide the reasonable assurance level that transactions are recorded so that companies can properly prepare their financial statements in accordance with Gaap. And the comment you see here is the obvious one, which is if someone identifies a material weakness in their internal control over financial reporting, well, how is it then possible that they don't have a disclosure control process weakness as well? And I think, Polia, as you were intimating, the companies that deal with this successfully, I think, are able to demonstrate that the process that they followed was actually the proper process, and usually it will involve showing the staff that the amounts involved and the materiality involved, and so it wasn't a failure of process in the good cases, but more just that they considered it and the amounts were not considered material, and as a result, there was this distinction, but it's certainly something that needs to be carefully considered. Likewise, with pro formas, I think it's very helpful to take a step back when you think about why do we even have pro formas. And I think in the manual and in other publications, I think the goal is really to show you or to show the investor what if we took a transaction and we put it into the historical financial statements and we did that objectively and we did that without management putting in all sorts of judgments and special effects, what would that look like? Because that can really give us as an investor a really good sense as to what's going on here. So comments that we see are things that would involve material adjustments or changing the initial accounting for transactions or contingent consideration and applying things in a way that really gets away from that goal. And you see lots of comment letters on pro formas that sort of deal with these issues.
Yeah, David, I agree. Like all the transactional related registration statements and proxies that we see go through our department usually get at least one comment on their pro forma information. So this area ripe for commenting, and it could be anything from how the consideration was reflected, like you said, in the pro forma, or the types of adjustments. Now, interestingly, the SEC staff has a big project on their agenda, and we hope that they come through with a proposal sometime during 2019 on proposing changes to Rule 305 on acquired financial statements and pro forma. And we are hearing informally that they likely will relax the current requirements in Article 11 and allow companies a bit more freedom and flexibility in what adjustments they reflect in preparing acquisition-related pro forma in particular. So more to watch in this area. Non-GAAP measures is our next topic. It tends to be among all registrants, excluding life sciences. Last year, for the fiscal year ended June 30th, it was the second area of most SEC staff comments. But as you can see, it doesn't appear in the top 5 for life sciences companies. So in general, the simple assumption here is, or a simple explanation is that life sciences companies seem to be doing a better job of preparing and disclosing their non-GAAP measures in accordance with Regulation G and Article 10 of SK. Some of the comments in here relate to whether the measure could be inherently misleading to investors, prominence issues, the business reasons for using the non-GAAP measures and how it is useful to investors. But a big one lately is tailoring Gaap accounting principles. I just want to remind you that in May of 2016, the SEC staff of CorpFin worked together with the staff in the Office of the Chief Accountant, and they jointly issued expanded compliance and disclosure interpretations in the area of non-GAAP measures. And at that time, they added a new CNDI, number 10004, related to tailored accounting principles that has been causing somewhat a lot of enervation lately and has been the focal point of their commenting in the recent past. So let's look first at slide 13 on this particular CNDI. The comments in that area spiked in the fall of 2016, then they kind of subsided during 2017, and now towards the end of 18, we're seeing many more comment letters come out, and they have a different flavor, almost to the point of it being challenging to pinpoint of exactly what are they considering tailoring accounting principle. So initially it started off as anything that would likely require the registrant or the people in investor relations that prepare earnings releases pulling out a spreadsheet and tweaking the mechanics of accounting. So if accounting, simply speaking, requires you to recognize revenue on a straight line basis evenly over a 3-year period, and that's what went into your US GAAP financial statements, but for purposes of your non-GAAP measure in the earnings release, you're tweaking that straight line revenue and front-loading and presenting half of it in year 1, the other half in year 2, and nothing in year 3, that likely would be considered tailoring an accounting principle because it's changing the basic or fundamental principle of accrual accounting. But these days, they're going above and beyond that, and I brought in here 3 examples from life sciences companies over the last year. The first one relates to the company was simply removing the step up in inventory that was acquired in a business combination. And that used to be done a lot, used to be kind of questioned by the staff in comment letters, but usually the staff wasn't asking companies to unwind it and remove that adjustment from the non-GAAP measure because it does represent when the inventory that's stepped up in a business combination is eventually sold, that step up represents a non-cash charge that usually goes through cost of goods sold. And companies were removing that amortization or charge related to the step up consistently with removing a lot of other non-cash charges. Well, that was previously not subsumed under this tailored accounting principles argument, but now they're starting to bring it in under this general umbrella. And it's very challenging for companies to justify that, and usually the SEC staff prevails and registrants have to change the non-GAAP measure to remove these adjustments. Another one that I gave you here as an example is the company had 2 classes of common stock, and it somehow through the non-GAAP earnings per share calculation, it became aware that they're not using the 2-class method, which is prescribed for US GAAP financial statements for earnings per share. So the staff asked the company to unwind that and change the mechanics of calculating earnings per share for their non-GAAP measures for the 2 different classes of shares. And in the third one, this one is a bit more typical and goes in line with the basic revenue example I gave you. This registrant was including milestone payments received in deriving its non-GAAP revenue, effectively moving revenue from the accrual basis to the cash basis of accounting. And some of the other non-GAAP related questions I've shown you here on slide 12 touch primarily for the life sciences industry on a couple of other CNDI. One relates to removing from your non-GAAP measure recurring cash operating expenses. So simply speaking, something that recurs more than twice and is an expense that's also paid in cash is going to be challenging to defend leaving in as a non-GAAP adjustment. The second example here relates to a registrant that gradually changed how it was preparing its non-GAAP measure. In this particular case, it was cash flow from, it was called free cash flow, to include investing inflows. And the staff questions in those cases whether the change is timely and appropriately disclosed to investors and whether conforming changes are made to the prior comparable non-GAAP measures for the other periods. And with that, we kind of are ready to wrap up this section on comments and trends, and let's look at whether we have some interesting questions from our audience today.
So Polia, I would just mention before I hand it back off to Dave that in a lot of these sections, just given time limitations, we cherry-picked examples and cherry-picked comments. So just wanted to make sure listeners, these are we're trying to give examples along the way of particular SEC comments that we're seeing on a recurring basis, and later when we get into Rev Rec and lease accounting, we're trying to give examples, but these are by no means exhaustive. We could have picked different comments or different examples. It's just meant to provide a little bit of illustration. Dave, with that, do you want to pick up on the SEC hot buttons?
Absolutely, Anna, and there's no better hot button to start on than Brexit, which is in the news today, and apparently on Tuesday we'll get a second vote. And so I think it's very insightful to see the way the SEC is looking at things like Brexit and LIBOR disclosures, because the staff clearly indicated they want to see this to the extent it's relevant and to the extent it's material. And when you think about this, every day you can read in the newspapers or hear on Bloomberg, some development about LIBOR or about Brexit at the macro level. But for companies in preparing their disclosures, it's really important to think about, yes, at some level, at the macro level, sure, if there's a hard Brexit, for example, then, potentially markets collapse and Forex markets, deteriorate and volatility increases and there are increased trade barriers, and that's bad for everyone's business. But for life sciences companies in this space who are actually doing things in the EU, manufacturing products, doing research, collaborating, that's a much more specific set of circumstances that would impact their financial condition and results, and that's the kind of disclosures that they would expect to see, the staff would expect to see. Similarly with LIBOR, and I know LIBOR is more of an issue for companies that have LIBOR-based either term facilities or just debt, but it's not enough to just say that LIBOR might be replaced and we think there may be this alternative or that alternative. If a company knows, for example, or has a view that its interest rates could be adversely effective, or if it, it would be very disruptive to its financing plans if LIBOR was replaced in a way that was disruptive, then that's the kind of thing that should be going into the disclosures. So that's what we've been seeing in this reporting season, and for the most part, companies that meet the criteria that I mentioned, particularly those with significant businesses in the UK and in Europe and elsewhere, and those that are impacted by that, really tried to put some thought into crafting something that's more specific than what you typically hear in the press.
So Dave, I'm going to pick up with cyber. So this is another area where the SEC, the Commission in early 2018 published an interpretive release that basically stated or reiterated its prior guidance and noted that registrants have to consider disclosure relating to cybersecurity and particularly cyber breaches in a number of sections of their SEC reports. But more recently, toward the end of the year, when Chair Clayton, as well as various representatives of the SEC accounting staff, spoke at the AICPA and at other conferences, they took great pains to emphasize that during this reporting season, the SEC staff is going to expect to see more specific, more tailored disclosures relating to cybersecurity risks. Again, depending on the type of business that a life sciences company is engaged in, this may be more or less important. I could envision in the health tech sector, where there's a lot of collection of data, cyber risks may be more significant than, for example, in connection with a drug discovery company. But nonetheless, the staff is expecting to see risk factors that are tailored, that are not generic, to the extent that there have been actual breaches, then they're expecting that the risk factor is going to be updated and is going to address the particular circumstances of the breach as well as the remediation and the costs associated with that. There's a duty, obviously, to update or correct once a company has been able to identify the ramifications of a breach. And we've seen that the SEC staff on the enforcement side has taken action where companies, for example, had actual breach experiences and had not updated their risk factors, which merely spoke to potential breaches. This also comes up, of course, in the MD&A section, in particular where companies are expected to address the costs that are related to addressing a breach, costs related to an investigation, costs relating to any threatened or pending litigation, and that comes up. An example of that is the comment that we have there on the bottom. So while this may be less significant for companies in the life sciences sector than in other sectors, for example, for internet-based or consumer companies, it still bears thinking about and also discussing with the audit committee. So with that, we're going to turn to two recently adopted accounting pronouncements and focus in on their effect for life sciences companies. And I think Dave's going to go first on RevRec.
Thanks, Anna. So this is a very significant change, and particularly for a lot of the biopharma companies and their relationships with larger pharmaceutical companies. So starting for calendar year companies in 2018, companies had to recognize the amount of revenue that was proportionate to what they actually delivered, to the goods and services they actually transferred to their customers during a period. And I think traditionally what I've heard from clients is that, ASC 808, which really, was the framework for collaborative arrangements, was very much useful for, just companies that had traditional research and collaboration agreements in particular. But ASC 606, which at some level, the 5 components of which, and Polia will talk about them in greater detail, but just looking at them from a high level, they seem simple enough. You identify the contract, you identify the performance obligations, you determine the price, you allocate it, and you recognize the revenue when the entity satisfies the performance obligations. That seems very, very simple. But in practice, and again, particularly with collaborations, with contracts that have contingent payments or variable payments, or with where things take place in steps and others, we've seen the staff, comment pretty heavily and ask for significant clarifications. And Polia, I'll turn it over to you on 22 to sort of go through some of those illustrations.
Yeah, David, you spoke just like an accountant.
Thank you.
Something else that's very significant with the new revenue standard is it formalizes the concept of variable consideration and basically asks the company to estimate it and include it in the total consideration at commencement of the contract when revenue recognition begins usually. So no longer having the concept of I will recognize only the fixed portion that I know of, and anything variable or contingent I'll recognize when it happens or in the period, right? I know and the contingency is resolved. Instead, I have to do my best to estimate how the contingency is going to unwind itself and recognize that variable consideration on an estimate as I'm going through the contract and the term, and then by the end of the contract term, true up to actually how the contingency resolved itself, right? So quite of a change from past practice because it effectively would drive companies to prepare some very significant estimates in the top line of their P&L, which historically we have felt is a firm line, but no longer. So to David's point on performance obligations, one of the most challenging aspects of this new revenue recognition standard is identifying the performance obligations within a contract. And that's not necessarily the separate services or products that are bundled within one contract. The simple takeaway is that a separate product may be a separate performance obligation, which means it is a separate unit of account. It gets consideration allocated to it and then recognized appropriately as the performance obligation is fulfilled. May or may not be. So a separate service or a separate product within the contract may or may not qualify to be a separate performance obligation. And we have an example here for a life sciences company that agrees to perform R&D activities over a 3-year period on slide 22. So this is a simple stylized case, but quite typical. They charge a fixed monthly payment for the R&D services, and they also get a $5 million milestone payment upon enrollment of 100 patients in a particular clinical trial phase. So, you know, the gold standard that when you receive your cash for that milestone payment, that's not necessarily when you recognize revenue, holds here because we have to be on accrual basis of accounting. And under ASC 606, if this particular company concludes that the R&D services that presumably are taking place evenly over the 3-year period, and the other service of enrolling patients are not distinct services, meaning from the customer's perspective, they entered into this total arrangement because they wanted to get both of them at the same time, and there's many other criteria to reach this conclusion that they're non-distinct, we would have one performance obligation. That means that all monthly payments over the 3-year period, plus the $5 million milestone payment, would make up total consideration that is allocated to one performance obligation. And if a decision is made that that performance obligation is fulfilled evenly, for instance, over the 3-year period, the total consideration would be recognized ordinarily in this case on a straight line basis evenly over the 3-year period, which effectively means that even if you subscribe your 100 patients through the end of the first year, some of the $5 million milestone payment would be spread out and recognized in year 2 and 3, even though you have accomplished your enrollment objective by the end of year 1. Now, the second paragraph relates to a biotech company that concludes the opposite. It concludes that from the customer's standpoint that's entering into this agreement with it, the customer is buying two distinct services. One is the routine R&D services, and the other one is just the enrollment service for the 100 patients. In that case, that company would have two separate performance obligations, and likely the second one, the enrollment of the 100 patients, would, number one, get some revenue allocated to it. Whether or not it's the $5 million is a different question, but let's assume it's the $5 million milestone payment, and that would be recognized either over the period of enrollment, let's say a year, or at the point in time when the 100 patients are enrolled. Effectively, once the 100 patients is earned over and enrolled, you recognize the entire $5 million portion of consideration allocated to this performance obligation, which is the second more conservative option. And so I know I said a handful, but it just demonstrates like a very simple example of 3 lines could have many different permutations depending on the judgments the company makes along the process. And that for similarly looking agreements, given some differences in how the customer is perceiving the arrangement and what is believed to be distinct, you could end up having different revenue recognition over the same 3-year period. Now, our next example relates to a customer option to purchase additional consumable cartridges. So a typical arrangement where a medical device manufacturer provides a device to a customer, let's say it's a hospital, performs installation services, and also provides 50 consumable cartridges to be used with the device. And let's say that's a 2-year period. But then they also provide an option for the hospital to purchase additional consumable cartridges, a certain amount of them, at a 25% discount from the list price. Whether or not any of the consideration provided for the original device and 50 consumable cartridges is allocated to the discount depends on whether that discount is considered a material right. If it is not a material right, all the consideration in that original purchase order for the device and 50 consumable cartridges would be recognized as those two elements are delivered, meaning nothing is going to be allocated to the discount and recognized when the discount is exercised by the customer. But if the discount is a material or substantive right, some portion of the original consideration would be allocated to it and deferred, meaning not recognized in revenue but deferred as a liability on the balance sheet, and recognized when the customer exercises the option to purchase the additional cartridges. So again, a mouthful, but demonstrates another highly judgmental element of the accounting model, and that is for the vendor to assess whether options provided in a contract with the customer represent, material rights that have to get separate consideration allocated to them because they're a separate performance obligation. Now, on collaborative arrangements, the model stays in place. It's still in ASC 808, but the FASB recently provided a clarification in 2018 to simply clarify that some parts of a collaborative arrangement may be units of account that represent revenue, and if so, the registrant has to follow ASC 606 to account for them. ASC 808 on collaborative arrangements as a whole does not contain provisions on measurement and recognition. It only deals with presentation and disclosure, but it directs the registrant to kind of try to figure out the separate units of accounting within the collaboration arrangement. And if it has, for instance, 3 units of account, one is revenue, one is a lease, the third one is a service, it would follow for each separate unit of account the respective U.S. Gaap that relates to that unit of account to measure and recognize the consideration over time. And so while it is a new accounting standard update, it doesn't change substantively practice. And we've noted here for you the effective date when disclosures about the standard have to go into the financial statements.
So Polia, you're going to go through and give a high-level overview of leases.
Sure. So the first slide looks a bit complicated, but it's simply a function of the complicated manner in which the FASB requires companies to adopt the leasing standard or the transition provisions. Generally, in accounting, we adopt new accounting standards either on a full retrospective method or on a prospective method from a point in time going forward. With the leasing standard, they came up with this modified retrospective application method, which is kind of tailored. It's a mouthful, difficult to explain. That's why we have this complicated chart. But it effectively introduces a day or a point in time when you're implementing the standard, and a second concept called the application date, which is an earlier date under one of the transition methods. So let's talk about that. When ASC 842 came out in 2016-02, I believe, there was just the first method of adopting modified retrospective application, where the application date is the first day of the earliest comparative period. So that means for a calendar year end, public business entity, or your typical SEC registrant domestic that is not an EGC, that is electing deferred transition, the adoption date of the new leasing standard would be January 1st, 2019. But when the registrant presents its 2019 full-year financial statements, it presents next to that 2018 and 17. So if we are looking for the application date of the new leasing standard, that would be January 1st, 2017. So again, even though we are adopting in Q1 of 19, the application date for purposes of calculating the adjustments and the accounting are as of January 1st, 2017. That's your application date. And that simply means that you look at all lease contracts that existed at that point in time, and you calculate your transition adjustment or cumulative effect adjustment due to the transition to the new accounting standard as of that date, January 1st, 2017. You book it to beginning retained earnings, and you move on from there. However, recently, in the fall of 2018, the FASB introduced a second modified retrospective method of adoption in an effort to simplify things for companies and make it easier for them to adopt. And that second method requires you to go back to the first day of the period of adoption only. So with the first example of a typical calendar year-end public company that is not an EGC, your adoption date is January 1st, 2019. So you're adopting in the first quarter of 19, but your application date is also 1/1/19. And you're not going to make any adjustments to the same leases that existed as of 1/1/19 to the prior periods. You're not going to have lease assets and liabilities on the balance sheet and the relevant P&L accounting. Private companies or non-PBEs have to adopt, if they're calendar year-end companies, at the end of 2020 in their full year 2020 financial statements, and they ordinarily present just one additional year in comparison to 2020. That will be 2019. So if they're choosing the first modified retrospective method of adoption, that means that their initial application date would also be 1/1/19. So that's a mouthful, but hopefully helped explain the arrows here, and that the bulk of registrants that had material leases and chose the original modified retrospective method of adoption that the standard originally contained are going back and adjusting their leases all the way through January 1st, 2019. Now, why is the new leasing standard important? It does represent a significant conceptual improvement over the old leasing standard in FAS 13. The old leasing standard had to be accompanied by a bunch of EATF consensus documents and interpretations, SOPs, and the totality of it was quite complicated. And in some cases, its application, particularly by lessees with respect to operating leases, was inconsistent. The new accounting model removes a lot of these inconsistencies and largely places all leases on the balance sheet, so to say, except leases that are very short-term in nature, and that usually is understood to be a term less than a year. The real estate-specific guidance is removed. Very important for SEC reporting companies, the table of selected financial data would have to be adjusted only up to the initial date of application. So if you have 5 years of P&L data, but your application is 1/1/17, you're going to adjust only 19, 18, and 17, and leave 2016 and 15 figures under the legacy ASC 840 accounting with an accompanying no disclosure about the difference. So that's why I spent so much time explaining what the initial application date is, because it ties back to your selected financial data table. Now, the definition of a lease, we gave you here a couple of examples to demonstrate the complexity around identifying what is a lease, because it doesn't need to be a separate agreement. A lease unit of account could be built into another larger agreement, for instance, a collaboration agreement. And that's important because companies cannot always, or it's not easy to say, well, this is my population of contracts that constitute leases for accounting purposes. A contract could be called an acquisition agreement, or it could be called a collaboration agreement or something else, but it may contain a lease. So it does require a lot of analysis and a contract-by-contract thought process. You have a lease in a contract when the issuer has the right to use identified property, plant, or equipment for a period of time in exchange for consideration. So sounds simple, but in the following example, we'll demonstrate that it may not be that simple. For instance, a biotech enters into a 3-year agreement with a CMO, a contract manufacturing organization, for a dedicated production line at the CMO manufacturing facility for product X. And in this particular case, the CMO is dedicated to use that particular production line only for the production of product X, nothing else, for a full 3-year term. So in this case, the registrant would likely conclude that the right for the registrant to use the production line at the CMO facility would constitute a lease because the production line is implicitly an identified asset if it cannot be used for any other purpose, and the CMO does not have the right to substitute what is being used for the production of that particular product X. So this particular agreement could be titled, from a legal perspective, an agreement for production of X, or an outsourcing agreement, which is where it becomes quite tricky for accountants because on the face of it, it may not be identified as a lease agreement, but as the example here shows, it does contain a lease. And a little bit more of the analysis behind that conclusion. Medical device companies in your space often enter into arrangements with hospitals to provide a piece of equipment, but also training, maintenance, installation, and some consumable product associated with that. So there usually is a lease for the equipment. And so from the total consideration, when the various units of accounting are identified, a portion of that consideration would be allocated to the lease of the equipment. And this slide talks about whether or not a company could take the practical expedient to group lease and non-lease components within a contractual arrangement and account for them as one. And ordinarily, they cannot take that practical expedient, that simplification in accounting, if the non-lease component is taking place or is being performed in a different pattern over time than the lease component. And so in our case, you can't assume, for instance, that the consumables are part of the lease of the equipment unless you've got data to demonstrate that the consumables are going to be delivered and used in exactly the same pattern over time as the even manner of using the device under the lease. And that was, I think, our on this slide we have our third and last example related to lease commencement. Again, an area of significant judgment for many lessees. The point in time in which you begin lease accounting may not be the point in time at which you're taking possession of the facility or the property. It may have to be earlier, and we are providing here a few examples to that effect.
Thank you, Polia. So the area of milestones and collaborations is obviously extremely important, particularly for the biopharmas, and it's really conversations that happen from the time these companies go public in terms of the IPO disclosure, and then once they're public, what to put in their periodic reports. On 37, what we've done is remind people that we approach this the way that we approach any material contract, and it's very important to have the key terms there. The SEC is very comfortable with addressing the confidentiality concerns around royalty payments. Typically there are confidentiality treatment requests that go in connection with many of these, and certainly a range of that's within a 10% range has been acceptable. We saw a very high-profile IPO in the biotech space last year, where a company had mid-single digits to 20% of worldwide sales, and that got through. So people are clearly comfortable at the staff with the concept that, particularly for a small company growing in the lab, facing a very large global pharma company, it would, this sort of information can remain confidential. But it is important, and particularly once the companies are public and filing 8Ks and Qs in annual reports, that we keep in mind, just the basics of describing material agreements that are set forth on 37. As on 38, as Polia had mentioned, when you're talking about the revenue recognition under these collaboration agreements, we see lots of comments from the SEC, really, trying to have companies justify as to why they've either aggregated milestones or what they've done under certain methods, what judgments they're exercising. And one of the themes that you've probably heard from us all day throughout the session is that, a lot of times there's a tendency to just leave this to the accountants or to the finance team and so forth. And my sense is, in dealing with the staff, is that if someone picks up these disclosures and can't really identify the judgments that have been exercised by the companies, then the staff is going to ask for further clarification. Clearly, the issue of whether or not milestones that companies think that individually are immaterial, whether or not those should be aggregated, that really does need to be considered on a case-by-case basis. But certainly, someone reading it should be able to understand the judgments that were involved. And we see many companies that go through a common process on something like this ending up with even maintaining the confidentiality of what's in the agreements in terms of payments and compensation, and in the ranges, still describing in much greater detail, the judgments and that they've exercised in connection with this. And so with that, I'll turn it over to Anna to talk about some MD&A developments. So in terms of MD&A, clearly the staff has identified in a variety of releases and statements what the goals of MD&A are. This is clearly an analysis. This is not just something of repeating, just sales went up by 5% or the results were there. One of the statements you put on.
To that point, Dave, I'm just going to pick up.
Great.
One of the areas that the SEC staff has spent most time commenting on is the need to provide more robust disclosure regarding known trends and uncertainties, and specifically having the MD&A be a roadmap for investors regarding what to expect. Oftentimes, as you'll see by some of the examples on slide 41, companies may be a little bit more forthcoming in investor presentations or earnings releases, and the SEC staff wants to see that insight regarding trends explained in MD&A. And so this also has been an area where the SEC over time the staff has provided a great deal of guidance. So we refer on slide 42 and on slide 43 to some of the guidance that's available regarding known trends and identifying known trends. This has recently been the subject as well of court cases. So it's very important to focus on making, in particular, the overview and the discussion of line items as helpful as possible in the MD&A section, and thinking about the MD&A as providing a narrative. So to the point that Dave was making earlier, it's not just a discussion. It's supposed to be an analysis to circle back to something that we started with early on in today's presentation. Just quantifying, percentages is not sufficient unless it's accompanied by an explanation of what the causes were for decreases or increases in specific line items. Similarly, in the life sciences segment, the Fcc staff is expecting to see a fair bit of detail regarding clinical trial progress for each product that's in the pipeline, more insights for when investors can expect there to be new information regarding new clinical data, new phases of the trial. So very important to address those. Another area as we close that is also a focus for SEC comment and a particular issue for life sciences companies. Unfortunately, given the sector and increases in patent litigation, there is a need always to consider loss contingencies and the SEC guidance regarding evaluating and on a quarter-by-quarter basis updating management's assessment of loss contingencies. Of course, we don't always have perfect insight regarding how litigation is going to unfold and the costs associated with that. But to the extent that there is insight that can be provided, it's important to do that and update it on a regular basis. The staff is not going to be happy seeing sort of the same boilerplate discussion quarter after quarter in a company's filings, particularly if the company has indicated in the narrative and litigation and the business discussion that there have been significant developments in the progress of the litigation. So with that, we're slightly over our time. We didn't get to everything we would have liked to have gotten to. A couple of reminders. We have included our alert on the changes to Form 10-K and Form 20-F that result from the SEC's amendments, simplifying disclosure requirements and eliminating outdated or redundant disclosures. So that's important to take into account. Also, there were recent changes to the threshold for what qualifies as a smaller reporting company. This is the time to be looking at that as well and considering whether, in light of those new thresholds, a company qualifies as a smaller reporting company. Thank Dave and Polia for their presentation, which was incredibly informative. There are a few questions that we didn't get to during today's session, and we'll make sure that we follow up with answers to those directly. Thanks very much for joining us.